WaFd Bank just delivered strong Q3 2026 results, showing a definitive beat against prior performance. Fully diluted EPS jumped a 15% year over year to 84 cents.
Right, and that's actually up 2% just from the prior quarter, too.
Exactly. And looking at the revenue proxy, net interest income landed at $181 million for the quarter.
Yeah, and their forward guidance is pretty solid. Management expects capital ratios to just hold steady, with total risk-based capital sitting right at 14.4%.
But the real story, or at least the massive potential regulatory tailwind here, is their option to step into the revised Basel III endgame framework.
Oh, for sure. Because opting in could reduce their risk-weighted assets by like 12.5%.
Which translates to roughly $317 million in unlocked capital relief. I mean, that's a game changer.
It really is. And, the market is absolutely already rewarding this consistency. The stock is up 19% just since March 31st.
Though, to be fair, that was significantly aided by the 4.7 million shares they repurchased earlier in the fiscal year.
Oh, without a doubt. Buybacks like that always help put a floor under the price.
Right. Okay, let's unpack this, because with the stock surging like that and EPS jumping to 84 cents, you always have to look under the hood.
You really do.
Is this earnings growth coming from core operational strength, or are we just looking at one-off items padding the numbers for the quarter?
Well, to answer that, we really need to break down the income statement line by line.
Right, getting to the weeds.
Yeah, and the first thing you look at with any bank is the net interest margin, the NM. It is the absolute heartbeat of their profitability.
Because it measures the difference between what they earn on loans and what they pay out on deposits.
Exactly. And WaFd's NM held completely flat at 2.81% for the quarter.
Okay, so it didn't expand.
No, it didn't expand, but crucially, it didn't compress either, which in this rate environment is a win.
Yeah, fair point.
However, if you look further down the statement, total non-interest income jumped to $24.2 million for the quarter.
Which is up from, what, $19.8 million previously?
Right. But a large driver of that specific jump was a $3.2 million one-off gain. They sold a branch property.
See, and that's exactly what I want to challenge here.
Yeah.
Selling off a branch property to boost non-interest income is essentially a sugar rush to the balance sheet.
I mean, it does juice the numbers for the quarter.
It looks great right now. It boosts the EPS, but you can only sell that specific piece of real estate once. It's a one-and-done transaction.
Right. You can't just keep selling buildings forever.
Exactly. If you're a retail investor looking at this, you have to wonder if the underlying operational efficiency is actually improving, or if they're just, selling off the furniture to make the house look richer while the day-to-day business basically stagnates.
Well, what's fascinating here is the broader efficiency story playing out underneath that one-off real estate sale.
Okay, how so?
Yes, the branch sale helped the top line of the non-interest income, but let's strip that away and look at the core operational engine.
The actual expenses.
Right. Non-interest expenses, the day-to-day cost to run the bank, pay the staff, keep the lights on, were completely stable compared to the prior quarter. They're sitting right at about $110.3 million.
So no bloated overhead creeping in.
Exactly. There were just tiny fractional increases in compensation, FDIC insurance, and tech. They're essentially doing more business with the exact same overhead.
Which means because they kept expenses flat while revenues grew, their efficiency ratio had to improve?
It did. It improved to a very lean 53.69%. which is down from 55.66% in the prior quarter.
And just so we are all on the same page here, in banking, a lower efficiency ratio is always better. It means it costs you roughly 53.5 cents to generate $1 of revenue.
Right.
Anything under 60% in this environment is showing serious cost discipline.
And that discipline flows directly to the bottom line. The ultimate proof is in the returns. WaFd delivered an 11.0% return on tangible common equity, or ROATC.
Let's pause there, because ROATC is it's a metric that separates casual bank investors from the pros.
It really is.
We're all familiar with standard return on equity, but the tangible part is what matters. It strips out all the accounting fluff like goodwill or intangible assets from past acquisitions and looks only at the hard, liquidish equity the bank actually holds.
Exactly.
So an 11% return on that hard equity proves the core engine itself is highly profitable, completely independent of whether or not they sold a branch building this quarter.
It proves the business model works.
Yeah.
But to keep that efficiency engine humming, to keep that ROATCE at 11%, you have to look at the fuel the bank burns.
The deposits.
Right. For a bank, the fuel is deposits. Maintaining a 2.81% net interest margin requires intense daily management of the liability side of the balance sheet. You don't just set your deposit rates and walk away.
Which means we need to look at how they are actually managing that deposit base right now.
Yeah, let's get into it. Total customer deposits are sitting at $20.9 billion. But the composition of those deposits is changing dramatically.
It's a very intentional asset liability management play.
Highly intentional. Over the last 9 months, their cheaper transaction accounts, the everyday checking and savings accounts people use to pay bills, those grew by 3.6%. That added about $439 million in new money.
Okay, but what about the expensive money?
Well, at the exact same time, their time deposits dropped by a massive 10.3%, which is about $945 million walking out the door.
And that $945 million didn't just vanish by mistake. They allowed those expensive time deposits to just run off the books.
Exactly. Letting deposits run off is a deliberate passive strategy.
Right. So when a customer's expensive 12-month CD matured, WaFd simply chose not to offer a sky-high renewal rate to keep them.
Yeah, if the customer wanted 5% to lock up their cash for another year, WaFd essentially said, no thanks, we're only paying 3%.
They willingly let that customer take their money to a competitor because paying a 5% premium on that cash was destroying their margin.
Precisely. And because of that strategic shift, core deposits now make up an impressive 80.6% of their total deposits. That's up from 77.9% back in September.
Here's where it gets really interesting. You can look at WaFd's deposit strategy right now like a balance sheet dietary cleanse.
A dietary cleanse, I like that.
Yeah. They are intentionally shedding all those heavy, expensive calories, the time deposits that cost them high interest, and they're working out to retain the lean muscle, which are those low-cost transaction accounts.
Because people don't usually move their primary checking account just to chase a quarter point of yield somewhere else.
Exactly. It's sticky money. By flushing out the expensive money and keeping the sticky money, their weighted average interest rate on deposits has dropped down to 2.39%.
And that leaner funding base completely changes their playbook. I mean, they aren't just sitting on that cheap cash. They are weaponizing it.
Oh, for sure. Putting it to work.
Right. While overall loan balances only grew modestly in the quarter to just over $20 billion, their active loan portfolios grew at an annualized rate of 10.4%.
That's the active portfolios, the areas where they're actually pushing to originate new business?
Exactly. They're taking that optimized lower-cost deposit base and putting it to work very specifically to generate higher yields on the asset side.
And if you're trying to figure out what kind of bank WaFd is today, look at this one data point. Out of all the loan originations in the third quarter, 96% were commercial loans.
Just massive.
Consumer loans made up just 4%. I mean, this isn't your local neighborhood savings and loan financing suburban houses anymore. They're fundamentally operating as a commercial lending engine.
It is a massive pivot in focus that really defines their modern identity. They did $1.5 billion in originations for active loan types this quarter alone.
Mostly replacing the runoff from the inactive consumer residential portfolios, right?
Yeah, mechanically, they saw about $299 million in repayments on older, inactive consumer loans like those 30-year fixed mortgages that just don't yield much in today's environment.
So they take that repaid capital and push it where?
They heavily targeted commercial and industrial, or C&I, and construction loans.
Which just churns the portfolio.
Yeah, exactly. This constant churn is actively replacing lower-yielding older assets with newer, higher-yielding commercial assets. It keeps their period-end loan yield incredibly strong at 5.33%.
But you can't just originate $1 billion in commercial loans without consequence. Commercial debt is a fundamentally different beast than a 30-year mortgage.
Oh, absolutely.
Because if a family runs into financial trouble, they will do everything in their power to keep paying their mortgage to keep a roof over their head. But if a business goes under, they default, and the bank is left holding the bag on a warehouse or a piece of equipment.
Right. It's a completely different risk profile.
So with this massive 10% annualized growth in commercial assets, how is WaFd preparing for the inevitable defaults?
Well, that exact dynamic is reflected in the most notable risk metric in this entire earnings report. The provision for credit losses spiked to $11.0 million for the quarter.
Wow. To put that in perspective, in the prior quarter, the provision was only $4.0 million.
Right, nearly tripled. But management was very explicit about this in the release. They tied this provision bill directly to that rapid growth in C&I and construction loans we just talked about.
Along with some localized concerns over adversely classified loans, right?
Exactly. They are looking at the elevated risk profile of a commercially heavy loan book and setting aside cash reserves to match it.
Seeing a provision jump from 4 million to 11 million sounds incredibly defensive. But to really grasp what's happening here, you have to look at how banks use these provisions almost like earnings thermostats.
Yeah, that's a good way to put it.
By aggressively setting aside $11 million now while profits are incredibly high thanks to good core operations, and that branch sale, they are absorbing the pain today.
Right.
If those commercial loans actually do go bad next year during a recession, they've already taken the accounting hit. It won't drag down their future earnings reports. They are essentially prepaying for future turbulence.
That's the crucial context right there. The provision is just a reserve. It isn't realized loss. Let's synthesize the actual asset quality here to see if there is real deterioration happening on the ground today.
Because there really isn't, right?
Not at all. Net charge-offs, the loans they actually had to officially write off as uncollectible this quarter, were only $1.6 million.
Which is up slightly from $0.6 million last quarter. But I mean, on a $20 billion loan portfolio, $1.6 million is effectively a rounding error.
Exactly. They are reserving heavily, but they aren't bleeding yet.
And the underlying metrics support that calm. Non-performing assets did tick up slightly, but only to 0.49% of total assets.
Right. That's up just 1 basis point from Q2.
Meanwhile, total delinquencies actually dropped to 0.75% of total loans, down from 0.78% in the previous quarter.
And because they proactively added that $11 million provision through the income statement, the total balance sheet allowance for credit losses now sits at a very healthy $234 million.
That covers 1.08% of their gross loans, which is really solid.
Yeah. If we connect this to the bigger picture, management's tone in the report is quite cautious, which totally explains their desire to build that $234 million fortress.
Yeah, they called out the macro environment pretty specifically.
In their risk factors, they flagged the shifting economic and monetary environment. We are in a prolonged higher interest rate environment, which puts overarching stress on commercial borrowers who have to refinance their debt.
Plus, the potential for a recession and global developments in Ukraine and the Middle East.
Exactly. That cautious macro view completely justifies taking a defensive $11 million hit to earnings right now to pad the reserves. They are seeing the commercial growth, but they are pricing in the macro uncertainty.
And speaking of macro uncertainty, there is one more metric all bank investors watch obsessively these days, especially retail investors remembering the banking crisis of a few years ago.
Uninsured deposits.
Uninsured or non-collateralized deposits. For WaFd, that metric ticked up slightly to 25.4% of total deposits.
It is a critical metric. Uninsured deposits are flight risks. If a bank gets into trouble, depositors with balances over the $250,000 FDIC limit panic. And with modern digital banking, they can wire their money out in seconds.
Right. But a 25.4% ratio means roughly 3/4 of WaFd's deposit base is sticky, fully insured money.
Yeah, it is not a red alert level. By any means, many regional banks run much higher, but it is a structural metric that management has to monitor daily. You don't want to see that creep up to 40 or 50% because that introduces massive liquidity risk.
So what does this all mean? We started by talking about their massive commercial growth, their incredibly flat and defensive margins, and their proactive provisioning.
Right. They're shrinking their expensive liabilities, expanding their high-yield commercial assets, and aggressively funding their rainy day reserves.
But I want to bring you back to the Basel III endgame guidance we mentioned at the very beginning. Because if WaFd finalizes that regulatory opt-in, it could act as a massive hidden catalyst for this stock.
It absolutely could. When we talk about risk-weighted assets under Basel III, think of it like a bank's mandatory safety cushion.
Right, because regulators look at the bank's loans and assign a risk score.
Exactly. They say, this commercial loan is riskier than a U.S. Treasury bond, so you need to keep more cash locked in the vault just in case it goes bad.
But if WaFd opts into this revised framework, regulators are essentially saying they can shrink that required safety cushion by 12.5%.
And that translates to freeing up roughly $317 million in total risk-based capital.
Which gives them a tremendous amount of optionality. I mean, how a bank deploys a $317 million windfall defines its next 5 years.
Oh, completely.
Will they hold it on the balance sheet to act as an ultimate shock absorber for any unexpected commercial loan turbulence? Will they use it to aggressively repurchase even more shares on the open market, reducing the float and boosting that 84-cent EPS even further?
Or will they use that capital to accelerate their commercial and industrial lending at a time when other regional competitors are capital constrained and forced to pull back?
It is definitely something to keep an eye on.
Absolutely. The optionality that comes with an optimized balance sheet and regulatory tailwinds gives them a distinct advantage in a tough macro environment. Thanks for digging into the numbers with us today.
We'll see you tomorrow for more daily, no-nonsense earnings coverage. Keep questioning the headlines and keep digging into the balance sheets.